Warren Buffett is a name that is known by almost everyone interested in the stock market. He's admired by many people because he accomplished something genuinely extraordinary. He became one of the richest people living, not via the development of modern technology or by inheritance of enormous sums of money, but rather by continuously outperforming the stock market for more than 50 years. In this video, we're going to learn how Warren Buffett became a self-made investing billionaire. Warren Buffett's massive fortune is tied to one of the world's largest companies, Berkshire Hathaway. Buffett's beginnings, however, are much more humble. He was born in Omaha in 1930, just as the Great Depression was kicking off. The stock market had crashed recently, and Nebraska was hit particularly hard. The state's economy relied on agriculture, and the collapsing price of crops left many communities in ruin. Buffett himself was born into the family of a local stockbroker, Howard Buffett. Warren's father was a smart businessman, so despite the crash, he was able to pull through and provide for his family. Once the economy started recovering, Howard's career took off, and in 1942, he ran for Congress as a Republican, eventually winning the election. This was surprising because of the immense popularity of FDR and the Democrats at the time. During his rise in politics, Howard moved his family to Washington, D.C., where Warren felt very lonely. He spent his days studying math at home and at school and reading investment books in his father's study. It is these early years that instilled in Warren the ambition to become rich. He would tell his friends in school that if he wasn't a millionaire by the time he was 30, he would jump off the tallest building he could find. As a young teenager, Warren started experimenting on the stock market, buying just a couple of shares to see how it goes. But Warren's ambition wasn't limited to just the stock market. He was obsessed with trying nearly every single business venture he could think of. For example, he would buy 6-packs of Coca-Cola at a wholesale price and sell them to his fellow students at a markup. His first real job came in 1944, when he started delivering the Washington Post around his neighborhood. With the money he made delivering newspapers, he would purchase pinball machines, which he would then place in stores around the neighborhood. However, things changed when in 1948, Howard Buffett, Warren's father, lost his re-election campaign, and the family was forced to go back to Omaha. Warren ended up selling his pinball business for a little over $1,000, and back home in Nebraska, he used that money to buy a 40-acre farm, which he then rented out. Warren used the farm's rent to pay his tuition to the University of Nebraska, where he got a bachelor's in business administration. He applied to the Harvard Business School when he was 19, but he was rejected. He then ended up going to the Columbia Business School. At Columbia, he met Benjamin Graham, a teacher who later went down as the father of value investing, who would change Warren's life forever. In his book, The Intelligent Investor, Graham lined up a step-by-step guide on how to invest successfully. In short, he encouraged his readers to find decent companies at bargain prices, essentially finding a $1 stock that was trading at half its value. Buffett fell in love with this method, and he quickly became one of Graham's favorite students. And just a few years after graduating, Warren went to work for Graham at his investment company, where he mastered the art of learning how to study a company's numbers and figuring out its true value. Unfortunately, just 2 years later, Graham retired and closed down his company, and Buffett was forced to look for employment elsewhere. At this time, Buffett had managed to save up $175,000 and started looking for companies that were essentially cigar butts, a company that looked worthless because of its undervalued by the market. For example, in 1958, Buffett noticed the Sanborn Map Company, which produced detailed maps used in the insurance business. The company had been around for nearly a century, and while it had been doing poorly for the 10 years, Buffett noticed something interesting on their books. The company had slowly been investing its profits for the past 20 years in over 40 different stocks. Buffett did the math, And it turned out that while the company's stock was trading at about $45 per share, just the investment portfolio alone was worth $65. So naturally, he started buying up the Sanborn stock until he held the majority of the voting power and liquidated the investment portfolio. In other words, he spent $45 to buy $65, and in 2 years he made a 45% return with almost no risk. Because of his smart investing, in January 1962, at 32 years old, Warren officially became a millionaire, just 2 years after he had promised to jump off a building. That very same year, Warren encountered a company that caught his eye, a struggling textile company called Berkshire Hathaway. The textile industry in New England was in decline for several decades now, and Berkshire had been forced to close 9 out of its 11 textile mills. The stock of Berkshire Hathaway was trading at around $7, but its assets were worth at least $11. But here's the thing. The company's CEO at the time was using whatever cash the company earned to buy back its own stock. Thus, whenever Berkshire sold off another mill, it would offer to buy out the shares of its own investors, essentially liquidating the company one mill at a time. Warren purchased a lot of stock at $7 and patiently awaited the CEO's offer to buy them back. A few years later, the CEO of Berkshire Hathaway approached him. The two men shook hands on a price, $11.50 per stock. However, when the day came, the offered price was only $11.375. The CEO had tried to cheat Buffett out of 13 cents, and as payback, Warren bought out the whole company and fired him. Now, Warren was stuck owning a declining company with no way to get rid of it. Instead of letting Berkshire go to waste, Warren started investing in stocks through the company with hopes of making the company somewhat profitable again. However, after his experience with Berkshire Hathaway, he had changed his philosophy. Instead of searching for mediocre companies at low prices, he started looking for amazing companies at fair prices. His first purchase using this new philosophy was American Express, a company whose stock he still owns to this day. Buffett applied his analytical skills to find the best stocks in the whole market. But that's only part of the reason he became successful. What really allowed him to make astronomical returns was his entry into the insurance business. That might sound like a strange statement, because at the time, insurance was considered quite unreliable and a very boring business. However, Warren was ahead of his time, which is why in 1967, he started buying up insurance companies, beginning with National Indemnity and ending with Geico in 1996. By investing in insurance companies, Buffett was essentially buying companies with $1 billion in cash that was technically considered a liability and thus wasn't a factor in the purchasing price. Suddenly, he had access to immense capital, which he invested wisely and carefully into some of the top companies in the world. By 1983, Berkshire Hathaway's portfolio was worth over $1 billion, and just 3 years later, Buffett himself was worth $1 billion. Today, Warren Buffett is worth a whopping $97.7 billion, and because of all his smart financial decisions and investments, he makes approximately $14.2 million every day. Thank you for watching this video. Make sure to leave a like and subscribe to our channel for more inspiring stories and advice from today's most successful leaders.